Hello, hi everyone. In this video, we are going to discuss an important topic in consumer behavior under uncertainty and risk. That is, the trade-off between risk and return. Suppose an investor has some saving. The investor may keep the money in a relatively safe asset, such as Treasury bill, or invest in a risky asset, such as stock market. The investor may also divide the saving between these two types of asset. This decision is similar to many economic choices where a person has to balance safety against the possibility of getting a higher return. Treasury bills are treated as a risk-free asset in this analysis. This means that their return is assumed to be certain. Let us denote this return by RF. Since the return is certain, there is no risk or variations in the return from Treasury bill. However, stocks are different. The return from the stocks is uncertain. We may earn a higher return or high return, a low return, or even face a loss. Therefore, when we invest in stocks, we are dealing with both expected return and risk. So the expected return on stock may be written as RM, while the actual return can vary around this expected value. So the main point is that risky assets usually offer the possibility of a higher expected return than the risk-free asset. But this higher expected returns comes with greater uncertainty. So an investor has to decide how much risk he or she is willing to accept in order to earn higher return. If the investor puts all the money in Treasury bill, the investment is safer, but expected return will be lower. However, if all the money is invested in stock, the expected return may be higher, but the investor will also face greater risk. Therefore, the investor does not simply ask which asset gives the highest return. The real question is how much additional risk I am willing to bear for higher expected return. This is called the risk-return trade-off. So in the next we will see how an investor can combine a risk-free asset and risky asset to form an investment portfolio, and how the expected return and risk of that portfolio can be measured. Now, let us see how an investor can divide saving between a risky asset and a risk-free asset. Suppose B represents the fraction of total savings invested in stocks. Since the remaining amount is invested in Treasury bills, the fraction invested in Treasury bills will be 1 minus B. For example, if B is equal to 0.5, it means that 50% of the savings is invested in stocks and the remaining 50% is invested in Treasury bills. So the expected return on the total portfolio here we can understood is a weighted average of the returns from these two assets. We can write it as RP is equal to BRM plus bracket 1 minus B into RF. Here RP represents the expected return on the portfolio, RM is the expected return on the stocks, and RF is the return on the risk-free assets. Let us take a simple example. Suppose the return on Treasury bills is 4%, the expected return on stocks is 12%, and the investor puts half of his saving in stocks. So RF is 0.04, RM is 0.12, and B is 0.5. Now, substituting these values in our above equation, the expected return on the portfolio will be Rp is equal to 0.5 into 0.12 plus 0.5 into 0.04. So this will give us an expected portfolio return of 8%. Now, let us consider risk. Here, risk is measured by standard deviation of return, that is represented by symbol sigma. If sigma m represents the standard deviation of stock returns, then the risk of the portfolio is written as sigma p is equal to b into sigma m. So this equation gives us an important idea. The risk of portfolio depends on the portfolio of savings invested in the risky asset. So if the investor increases the proportion invested in stocks, portfolio risk increases. If the investor reduces the proportions invested in stock and keeps more money in treasury bills, portfolio risk decreases. So, by changing the value of B, the investor can choose different combinations of risk and expected return. So, this becomes the basis for understanding the investor's choice between safer and riskier portfolio. Now, let us move to the investor's choice problem and the budget line. Here, the investor has to decide how much of total savings should be invested in stocks and how much should be kept in treasury bills. In other words, the investor has to choose the value of B, that is the fraction of savings invested in risky asset. From our earlier portfolio equations, Rp is equal to Rf plus B bracket Rm minus Rf. Here, Rp is the expected return on the portfolio, Rf is the risk-free return, and Rm is the expected return on stock. We also know that portfolio risk is sigma P is equal to B into sigma M. From this equation, we can rewrite B is equal to sigma P divided by sigma M. Now, if we substitute this value of B into the expected return equation, we get Rp is equal to Rf plus Rm minus Rf divided by sigma M into sigma P. This equation gives the relationship between the expected return of the portfolio and the risk of the portfolio. When this relationship is shown in graph, we get the budget line or the risk return line. In this graph, on the horizontal axis, we measure risk represented by the standard deviation sigma p, and on the vertical side, we measure the expected return, that is Rp. Here the budget line starts from Rf, means the risk-free return. At this point, the investor keeps all the money in treasury bill. Therefore, portfolio risk is 0. As the investor moves upward along the budget line, a larger portion of savings is invested in stocks. Therefore, both expected return and risk increases. So, the slope of the budget line is Rm minus Rf divided by sigma M. So, this slope tells us how much additional expected return the investor receives from taking one additional unit of risk. So, every point on the budget line represents a possible combination of risk and expected return. A point nearer the lower end of the line represents a safer portfolio with lower expected return. A point further upward represents a riskier portfolio with a higher expected return. Therefore, the investor choice problem is to select the most preferred point on this budget line. So, in the next section, we will see how indifference curve help us identify that optimal point. Now, let us see how the investor chooses the best combination of risk and expected return. In the figure, you can see we have three indifference curves, U1, U2 and U3. Each indifference curve shows different combinations of risk and expected return that give the investor the same level of satisfaction. These curves are sloping upward. The reason is simple. If the investor has to accept more risk, he or she must be compensated by a higher expected return. So, higher risk must be matched by higher expected return. The different indifference curve represent different levels of satisfaction. A higher indifference curve gives a higher level of utility. Therefore, U3 is preferred to U2 and U2 is preferred to U1. But the investor cannot choose any point freely. The feasible combination of risk and return are limited by the budget line that we have already discussed. So the investor tries to reach the highest possible indifference curve while remaining on the budget line. The best choice occurs at the point where an indifference curve is tangent to the budget line. You see in the figure, the indifference curve U2 is tangent to the budget line. At this point, the investor gets an expected return of R star and faces a risk level of sigma star. This point represents the optimal portfolio or the utility maximizing portfolio. At the tangency point, the investor gets the highest possible satisfaction from the available risk-return combinations. Any other point on the same budget line would give a lower level of satisfaction. So the main idea is that the investor chooses neither the low-risk portfolio nor the highest return portfolio automatically. The investor chooses the combination of risk and return that gives the maximum possible utility according to his or her preferences. Next, we are going to understand the different investors and different choices within this framework. Different investors are willing to accept different levels of risk. In fact, this is because people differ in their attitudes towards risk. You can see in the figure, we consider two investors, investor A and investor B. Investor A is very risk averse. This means that investor A does not like taking much risk. Therefore, the indifference curve of investor A is relatively steeper. The indifference curve of investor A is tangent to the budget line at a point with low risk, that is sigma A, and a relatively low expected return, that is RA. Since this return is only slightly above the risk-free return, investor A keeps most of the money in Treasury bills and only a small amount in stocks. Whereas investor B is less risk averse. So investor B is willing to accept more risk in order to obtain a higher expected return. The indifference curve of investor B is flatter. It is tangent to the budget line at a point with a higher risk, that is sigma B, and a higher expected return, that is RB. Therefore, investor B invests a large portion of savings in stocks. Here the main idea is that investors do not necessarily choose the same portfolio, even when they face the same investment opportunities. A more risk-averse investors prefer a safer portfolio with more treasury bills, while a less risk-averse investor is willing to hold more stocks. So, the less risk-averse an investor is, the greater will be the proportion of wealth invested in the risky asset. Now, let us discuss buying stocks on margin, which is also called leverage. Some investors are willing to take a very high level of risk. They may want to invest more than 100% of their own wealth in the stock market. But how is it that possible? They do this by borrowing money from brokerage firm and use that borrowed money along with their own money to buy stocks. This is called buying stocks on margin. So buying stocks on margin means purchasing stocks partly with your own fund and partly with borrowed fund. This is a form of leverage. Leverage means using borrowed money to increase the amount invested. By doing this, an investor can increase the expected return on the portfolio. But at the same time, leverage also increases risk. So, leverage can rise both expected return and risk. You can see in the figure, investor B is a less risk-averse investor. The indifference curve UB is relatively flatter, showing that this investor is willing to accept more risk in order to get a higher return. The tangency point for investor B lies at a point where both expected return and risk are greater than those for the stock market itself. In other words, in the figure you can see that RB is greater than RM, which implies the expected return of investor B's portfolio is greater than the expected return on stocks, and sigma B is greater than sigma M, which means the risk of investor B's portfolio is also greater than the risk of stocks. This can happen only because investor B is borrowing money and investing more than 100% of her own wealth in stocks. Therefore, leverage allows the investor to move beyond the normal stock market point and choose a portfolio with a higher risk and a higher expected return. But we must remember that leverage is a double-edged sword. If stock price rises, gains can become larger, but if stock price fall, losses can also become larger. So, the main idea is that buying stock on margin increases both potential return and potential risk. It is suitable only for investors who are willing to bear higher degree of risk. To conclude, investors choose between risk-free asset and risky asset according to their willingness to bear risk. The budget line shows the available combination of risk and return, while indifference curve shows investors' preferences. A more risk-averse investor prefers safer asset, whereas a less risk-averse investor chooses more risky asset and may even use leverage. The main idea is simple. Higher expected return generally require higher risk, and final portfolio depend on the investor's attitude towards risk. That brings us to the end of this discussion on the demand for risky asset and the risk-return trade-off. Thank you for watching, and I hope the video has helped you understand how investors balance risk and return while making investment decisions. Thank you.